Now we look at pricing and valuation of these contracts per se. So before we start, any doubts you guys have on any of those contracts derivatives so far? Because now we have to learn how to price them and value them. That is going to be quite tricky. Okay, you won't know it till you know the details of these contracts. Right. Uh, Please confirm you can see a screen, right? So we look at valuation and pricing of these contracts. Okay, that's critical. Sure. Value and pricing. Okay, we'll do it each contract. We'll go step by step. First, look at a forward contract. Now, remember, I want to do it at the initiation stage, during the life of the contract, and expiration stage. In the exam, they could ask you for valuation and pricing at any point. Okay, it could be at any point, and there are 3 points. There is starting, which is today. There is expiry, which is time t at expiry, and there is during the life. Okay. So at any point here, they could ask you this point or this point. You have to learn all the 3. Okay. And obviously then we learn how they used to determine, which we've done this in the earlier chapters as well, how to determine the interest rate forward contracts. Yeah. Now, you already know the formula I taught you in the no arbitrage pricing section earlier, where I told you the forward rate is equal to the spot rate, right? Into 1 plus R raised to T. Correct? So that's the same answer. If I want to find out what is the forward price, right? Forward price. Now, what is forward value is important. Forward value is nothing but the implied forward price. So value is nothing but the implied price from the above equation minus the current market price of the forward. So the forward ka market price is maybe 100 and you realize the value should be only 98. Then 2 is the value of the contract. Got it? So nothing but the market price minus the theoretical price. So forward price is what you learned through the no arbitrage formula, and value is the difference between this price and the market. Obviously, on the date of the contract, we discussed how arbitrage riskless profit is not possible. So on the date of the contract, every forward has a 0 value, because on the day of contract, the forward price and the market price will be same. Right? If it's not, then you'll have arbitrage profits. Clear? So on the date of the contract, this value will be equal to this value, giving you 0 value. Clear? But after the contract is entered, right, during the life or at settlement, there will be some value of the contract because the market price will keep changing. Correct? And the market dynamics will change, the spot price will change, the risk factor will change. So the value of the contract at settlement or during the contract life, okay, is going to be, look at the formula I just told you on earlier page, is going to be based on the spot price on that date, which is the actual price, minus the implied forward price. Clear? And why is it going to change every time? Because the spot price keeps changing. Correct? So at settlement also, the spot price is different. In the contract life, after 1 month, 2 months, 3 months, the spot life keeps changing. So every time the spot changes, the value will keep changing. Clear? Now, if I want to find out the value of contract, remember, I'm discussing forwards. So in a forward, the long will equal to the short. But one will have a positive value, one will have a negative value. If he has a negative value, the short will have positive value, right? But do remember that the values in absolute terms are going to be equal. Clear? How much is that value? There's a formula to help you. Clear? Now what's the formula? On the expiry date, it's simple. Take the market price, take the forward price. You have settled a contract. If the market price is going for 100, but your contract is showing 102, you have a clear profit. Good job. So on the settlement date, it's straightforward. Whatever you get from the contract is your profit. But if the contract not yet settled, it's awaiting settlement, then you have to find out what will be the value at settlement and then discount that to today's value. Clear? So you will take the value that's there in the market. So let's say it's a 6-month contract, and after 4 months, I want to know the value. So I'm saying, what's the value after 4 months? So you'll say, fine. You know the value after 6 months. You know for price. Usko discount karo. Discount to today's value. Find the PV by discounting 2 months. And that PV you compare to the current price. What is this PV? What is current price? The difference between the future value ka discounted price and the current price is the value. The future price known to you. When you discount it, you will get the present value today. The difference between present value today and the current stock price is your value at time t. Clear? Any questions? So you learned value at 3 times. At time 0, value is 0. At time t, the value is the difference in the market and the forward price. During the life is the difference in market and the forward price. But since it's during the life, forward price ko discount karoge by the remaining life of the contract. If there's 2 months left, I'll discount for 2 months. So this year, if you see, is nothing but the remaining life. Uske liye tum discount karoge. Clear? Any questions?
No, sir.
Okay. Chalo, good. Let's try to look at a good example now. This one office owns 10,000 shares, right? Spot price 295. They are selling forwards for 1,000 shares at 300. So today's value is 295. They sold it at 300.84. Correct? And the time period is 6 months. They're asking you for the contract value at maturity. Which really?
I want to sell it. In the picture, we have taken out the ceiling. To sell that.
But it's useful.
Yeah.
So who you want to give to?
She's come now.
So donate it to me. But she'll really use it or what? Ask her. So they're telling you if the spot price at maturity, okay? Now this is a forward, okay? Now I have 2 scenarios. Scenario 1, the spot price is 287. Scenario 2, the spot price is 3112. This is at maturity, right? So what's the answer? Now you realize this is pretty much useless. Correct? This is useless because this is just to help you to get the forward price. You sold a forward for so much. Correct? Now on the date, you go to close a contract. If the spot price is only 27 and you are able to, now remember, are you buying or are you selling? You sold. The key word is you sold the forward. Correct? When you sell the forward at this value and the market price is only so much, are you making a profit or a loss? Answer? Is it a profit or a loss?
Profit.
Huh?
Profit.
Very good. So straightforward answer. Good. So it is a profit to the buyer or the seller?
The seller.
Very good. So you need to say like this. Seller profit is the difference of $13 or 12.16 and the buyer's loss is the difference of $12.16. Understood? Okay, but remember, seller's profit equals buyer's loss. But tell me the scenario. If the market price is 312, you agree to sell at 300, profit or loss? Answer?
Loss.
Loss to the seller and profit to the buyer. Clear? Good. So this is obviously very simple where I'm giving a fast sum to find out value. So buyer, yeah, seller had a profit, you said right in the first scenario. Seller had a loss in the second scenario. What you notice is the profit equals your loss. Okay, sure. Well done. Good job. I could have. Okay, I'll come to that sum, but there should be another example where I tell you that not at time 0, not at maturity, but if the amount at after 3 months or 4 months is something, then is a valuable, is it was a value. Okay, we'll come to later. Okay, forward rate agreement. Now, what's a forward rate agreement? FRA is basically an agreement where, see, forward rate means where I'm agreeing for a rate in the future position and it's a forward contract. That means I have an obligation. Okay. Now, when it comes to rate, remember, rate means it can either be fixed or it can be floating. When I enter into a forward rate agreement, I may either convert fixed to floating or floating to fixed. Obviously, there's no third answer, right? Either fixed floating or fixed floating. They are saying I have exchanged fixed for floating, right? Fixed for floating. So if I say fixed for floating, that means I'm receiving fixed and I'm paying floating. Correct? I'm exchanging fixed for floating. मैं fixed ले रहा हूँ, floating दे रहा हूँ. So the person who's buying the contract is the person who is paying fixed rate. So when I buy FRA, long FRA, learn this carefully. You have to understand what is it, floating for fixed or fixed for floating. When I go for long FRA, long means I'm buying, right? They have to tell you in the sum, is the person a fixed rate payer or a floating rate payer? They will mention that to you. Please don't assume. So when I'm going long, remember, I am paying interest, right? What I agree for. That interest, example now, the sum, if I'm paying fixed, right? And the floating rate, MRR is floating, is more than fixed, right? So I'm paying fixed and I'm receiving MRR. Okay, I'm receiving MRR. MRR is like LIBOR. Now tell me, if MRR is more than fixed, then will I receive money or will I pay money? See, I'm paying fixed and I'm receiving floating. So in the first settlement period, if I'm receiving MRR which is greater than fixed, right, whatever the number is, then net, will I receive money or will I pay money? Net. Answer?
Receive.
Very good. If my fixed is example 8%, but MRR is 9%, that means 9 is more than 8. So mota moti, I will receive how much? 1%, no? See,
There were so many clothes bags like this.
1 minute, it's all in this. I kept in this, donate that bag also. Check, yeah. Just check if all the 3 bags are here and donate that, it's fine. Just check if those exact 3 are already kept. So see, look at this. You said you'll receive correct answer. How much you receive? The net difference. On what amount is also important. It's on the notional amount. So मैंने बोला, check if those 3 bags are correct bags. All 3. So if my loan is 1 million and I agree to pay 8%, but I'm receiving 9 on settlement date, because the rate is 9%, I made a profit. अभी याद रखना MRR हर quarter change होगा. ये क्वार्टर तो मैं लकी निकला, 9% है. So this quarter, I am going to make 1% profit on loan amount, but 3 months. So my payment this quarter will be receive MRR minus fixed 1% of loan amount और उसका discounted value. खत्म. Next quarter, let's say MRR 9 नहीं 7 हो गया. So you will now pay, right or wrong? You'll pay. If MRR became less, you will pay the difference into NA. But remember, you'll pay the present value because the settlement is always 3 months later. That's all you have to learn in this concept. That's all you have to learn in forward date agreement. कि भाई आज का MRR कितना है? But do understand, you should first know whether you are a fixed rate payer or floating rate player. You have to first decide that. ठीक है? Got the concept? If you're floating rate payer, then you'd have benefited if your MRR is lesser. Then the maths will change. Got the logic? Any questions?
No, sir.
Got it? Clear? So the key term to look out for is what's your position? Fixed rate payer, floating rate payer. They may also call you fixed rate receiver or floating receiver. Okay. Once you decide that, your answer is sorted. Okay. So that is your FRA.
Does not go with that rule. Can I give it to you?
Okay, but don't ask to buy one more clock coming now. We bought like 3, 4 already.
There are only 2 clocks.
That's enough. We have 10 minutes. Give it if you want, but don't buy one.
Okay.
If you want to keep, then you keep. FRA. Okay. Now, look at this. When you establish a fixed rate, okay. Now remember, today I'm saying I'll pay fixed rate, like I told you 8%. The floating rate discovers, obviously, you know, every 3 months, because floating rate changes every 3 months, right? So then the floating discovered, your value will change. Remember, you have to consider the period of the contract also. Example, let's say I established fixed rate. After 1 month, I got the floating rate, but the contract is for 4 months. I need to consider the discounting for the 3 months also. And don't forget, if it's year, I may need to consider the compounding for 1 year also. Clear? So in a FRA, please remember to draw a timeline and check where am I sitting on the timeline? At which point am I sitting? Then you'll get your answers. Okay? So what does FRA F13 mean? F13. It means after 1 month, 3 months are remaining. 1 महीने के बाद 3 महीना pending. Clear? So just learn the interpretation. These are quite important. Okay. FRA F13. After 1 month, 3 months remaining means I am looking at something 1 month later, right? But I want to take only for 3 months after 1 month. Got it? So 1 indicates the time after which you will take the contract, and 3 indicates the time for which you will take the contract. Clear? Okay. So F13. So think carefully. What is F24? Answer. What is F24? I'll borrow after how many days? 2 is 2 months. 60 days. Very good. Later. And for how many days loan will I take?
120.
Right. Don't say 60-day loan, saying that 4 is including 2. 4 is not including 2. 4 is 4 more. Okay. 120 days loan or this. But this was your mom's, you know. If she doesn't want, then give. But you ask her. Then give. We have enough. They'll use it now. Are we clear? 60 days, 120 days. Okay. So obviously you can replace in the cash market. So if I tell you after 30 days, I want to borrow for 90 days, that is also same as lending for 30 days and borrowing for 120 days. Hai? See, if after 30 days, I'm borrowing for 120 days, I'm borrowing for 90 days, it is as good as saying that I'll borrow for 90 days, but उसमें जो सिर्फ 120 days by only 90, right? So extra जो 30 days है, वो 30 days के लिए मैं lend करता हूँ, और बाकी 90 days के लिए I will be on the borrowing side. Clear? So this is called replicating. Because see, I can't go and say 30 days ke baad 90 days. So I'll simply take 120-day loan and lend it for 30 days. Got it? It's easier to do this in a cash market. Clear? So please understand, if they ask you to replicate a FRA, if that's what I tell you here, 1 month later for 3 months is also equal to abhi le lo 4 mahine ke liye aur 1 month ka lending kar lena. You will get the same replication. Clear? Why we do it? Because it's a forward rate agreement. It's an agreement where you have to deal in the forward duration. Okay. And this, what I just taught you, will help you to also compute the valuation easier. Example, look here. Let's look at this. First, tell me F36. Matlab kya hai? Answer. F36.
Lend for 3 months, borrow for next 6 months.
Who is she? Why she's coming?
You want some job, leave it. I'm just seeing one last time.
What is F36? Sorry, look, what you said, F36 is what?
Lend for 3 months and then borrow for 6 months.
No. Think of the original amount. Original, definitely I told you. I'm not lending at all now. Lending, borrowing comes later. First, you have the original equation. F36 means what? How many months later?
Okay.
3 months later?
3 months later for 6 months.
Correct. That is what you learned originally, na, Baba? Okay. So that is the correct answer. 3 months later, I'll take a 6 month. Now convert that into what you said. If I do that, what I'll do? I will borrow now for how many months? Now answer the second
6
option.
months.
No, 9 months. I'll borrow for 9 months and lend for 3 months. You want 6 months loan, right? So how can I borrow 6 months then lend for 3 months? Making sense or not? After
Okay,
3 months,
yes,
I want.
the total period.
So 6 months ka 3 months ke baad, which means I could borrow for 9 months and lend for 3 months. Is that clear? You got both the meanings now? Okay. And also to months mein boliye, but it could be in days also. Clear? So 90 days later, I want to borrow for 180 days. Correct? 90 days later. Okay. So simple. So look at the rates. So here they're saying 6 month MRR. 3 months from now. Now remember, you're dealing 3 months from now, obviously, right? So look at the timeline. Today's rate is 1.3. Floating rate after 3 months when your contract starts is 1.5. Correct? Now 1.5 is floating rate for the next 6 months. Correct? For the next 6 months. Because they told you 6 month MRR is 1.5. What is the rate going to be applied on? Notional amount of 1 million. This is your notional amount. Because this loan is not exchanging hands, it's just a notional amount. Now tell me, what is the payoff going to be? Answer. What will be the payoff? Okay, you want to know you're a fixed rate payer or buy? We'll say you're a fixed rate payer. You're a fixed rate payer. What's the payoff? I'm just thinking how they're not shown the solution. Yeah, but yeah. So if you are a fixed rate payer, right? Look here. If you're a fixed rate payer, you're supposed to pay 1.3 or receive 1.5. So for a fixed rate payer, you will earn 0.2%, right or wrong? Of 1 million is what you'll receive. But remember, it's only for 6 months because the 6 months rate. Now don't think that 1.5 is the rate for 6 months. 1.5 is the per annum rate. Samjha? 1.5 is the per annum rate. Okay, and that per annum rate has to be converted into 6 months upon 12 months. Clear? So your answer is 0.2% million. You're agreeing with that? I earn 0.2% because I'm paying 1.3, I'm receiving 1.5 on 1 million for 6 months. Now, if this value is as of this date, then you're okay. But they tell you what's the value as of this date, then you have to discount it, do divide by 1 plus R raised to 3 by 12. Okay? That's only if you do that. You can do a calci also. So please understand, where are you stuck? Which period are you looking at? Clear? Now let's say a floating rate pair. Abhi tum batao. Answer kya hoga? If you were a floating rate pair, then what will be a payoff P? What will be a payoff?
A floating rate, I'll have to pay 0.2% of
Very
1
good.
million.
Very good. Ulta, you could just say the answer is minus. Because the fixed rate pair hai, wo floating rate pair ko dega paisa. So it's the exact opposite of that. Clear? 0.2%. Very good. Okay. That's how it works. So you have to know what are you. Now see, this is a new example. Now you think carefully and tell me what is the answer. And they're telling you you're a fixed rate pair. Start. Tell me what's the payoff. Payoff means the value. Okay. Batao, kitna hoga?
I'll have to pay 0.3% of 1 million because the fixed rate is greater than the MRR.
Very good. 0.3% of 1 million. For what period? Is it entire 0.3%? That plastic transparent bag you gave, is the bag you give or the bag you want? The one bag closer to want. You checked properly each one that you gave again, check. Huh. So the answer is 0.3%. That's correct. Into 1 million also is correct. Anything else will do?
So for 180 days.
Very good. 180 days bhulna mat. Okay. It is only for 6 months. Okay. And further, agar isko discount karna hai, then you'll do divide by 1 plus R. Okay. If you bring it to this value. So find out yahan pe value karna hai ki yahan pe value karna, right? Okay. Very good. See, remember this payoff will happen normally at which date? At this date or this date? This payoff will happen at this date. Samjha? Because you'll pay the interest after the loan period, no? You won't pay in advance. So payoff क्या होता है? इधर होता है. But अगर उन्होंने बोला कि आज का value बताओ मुझे payoff का, तो तुम उसको present value ते लेके आओगे. And how to do it? Use a CFA calculator and get the value based on that. Okay. So let's try to look at a sum now for this. Okay. We have a company that expects to borrow, okay, 1 million for 6 months in 3 months. Simple. So 3 महीने के बाद 6 महीने के लिए it will take this. So tell me this will be 9 months. 0, 3, 3 2 plus 6, 9 months. So आज से 9 महीने में deal खत्म होगा, right? So this is also an example of FRA 3 what comma 6 है ना? Not 3 comma 9, 3 comma 6. 3 months के बाद 6 महीने के लिए, right? So please learn this connotation. Exam में पूछते हैं. FRA 3-6, right? लिखा है यहाँ पे, right? 3 months के बाद 6 महीना, तो total 9 months हो गया. They are saying he is pay fixed, मतलब fixed pay, and they are telling you the rate is 1.3. Brilliant, काम खत्म हो गया मेरा. Now look here, company is paying 1.3, company receiving floating, correct? अब floating तो unknown है, right? But this is my connotation. Company 3 months के बाद will borrow for 6 months. How much will it borrow? $1 million. At what rate? 1.3% pay करेगा. Receive कितना करेगा? पता नहीं. The difference will be your pay or receive for the 6 months accordingly. Simple. So you have to learn to break down the sum into a timeline. मैं वही बोल रहा हूँ बार-बार. Timeline बना दो, your answer will be always correct. Just make sure you have the timeline set. अभी उल्टा है. Company is lending for 6 months in 3 months and can fix the lending rate with a pay float position. Pay float. Pay float means what? In FRA. Now what does it mean? Same sum. FRA 306. But the only difference is After 3 is going for a rate where it's floating rate दे रहा है और ले रहा है उससे 1.3% fixed rate. समझा? It is receiving fixed, see the direction of the arrow, and it's paying floating, which I don't know. Correct? So company can do both. Company can decide. See, while a company, it can use it for both, right? It can play floating, receive fixed, or pay fixed and receive floating. Right or wrong? This is how it goes. Now you answer this question. Answer this question. Why would a company want to pay a floating rate and receive a fixed rate? Why did it enter into forward rate and say, भाई मैं floating दूंगा तू मुझे fixed दे? ऐसा कौन करेगा? मतलब what type of company with what exposure will enter into this forward contract? Think. It's a very intelligent question. Think carefully.
Could you repeat?
What company would want to enter into forward contract where it is paying floating? It is paying floating, that is unknown, and receiving a fixed amount which is known. It is saying मुझे 1.3 fixed चाहिए और मैं तुझे floating दूंगा. Floating could be, 1.4, 1.5, could be 1.1 also, right? But which company will do that? Which type of company involved in which exposures will do that? Answer.
Sir, a company जिनको पता होगा कि they will make उतना profits to pay off
No.
any amount in the future.
Which company will want to pay floating and receive fixed? Simple answer है. जो कंपनी को फ्लोटिंग रेट के हिसाब से कुछ मिल रहा है बट उसको फिक्स चाहिए. Let's say there's a corporation which is it has already lent $1 million and is receiving floating. ठीक है, वहां से फ्लोटिंग मिल रहा है बट ये बोला यार फ्लोटिंग रेट में मजा नहीं आ रहा है क्योंकि फ्लोटिंग रेट अगर कम हो गया तो मेरा तो इनकम कम हो जाएगा. अगर फ्लोटिंग रेट 1.5 है, 1.2 हो रहा है, 1.1 हो रहा है, 1 हो रहा है, 0.8 हो रहा है, ही लाइक शिट आई एम लूजिंग मनी. सो ही इज कंसर्न कि भाई जहाँ पे मैंने लेंड किया वहां पे फ्लोटिंग रेट इफेक्ट हो रहा है. ही विल गो एंड एंटर इनटू कॉन्ट्रैक्ट हियर एंड ही विल से आई विल पे फ्लोटिंग एंड आई विल रिसीव फिक्स्ड. तो उससे क्या होगा, वो जो फ्लोटिंग मिल रहा है उसको वो इधर पे कर देगा और यहां से फिक्स मिलता रहेगा. सो ही इज कन्वर्टिंग दैट फ्लोटिंग इनटू फिक्स. अभी उसको हमेशा 1.3 मिलेगा. अगर यहाँ पे उसको 1.5 मिला तो 1.5 दे देगा, खत्म. अगर उसको 1.1 मिला तो 1.1 देगा, खत्म हो गया. अगर 0.8 मिला तो यहाँ पे 0.8 देगा, खत्म हो जाएगा. वहां पे जो मिला यहाँ पे देगा, उसको हमेशा 1.3 ही मिलेगा. उसने अपना पूरा इनकम फिक्स कर दिया. Like got the logic what I'm saying? You understood or not? So company which has an existing floating rate receipt will probably say, I want to give my floating and receive rent fixed income. He can't go and change the original agreement, but he will enter into a swap. Abhi samjha ki nahi? Got the logic or not?
Yes, sir. Yes,
तो
sir.
वहां का फ्लोटिंग इधर दे देगा और यहां से फिक्स लेगा तो वो फ्लोटिंग ये फ्लोटिंग किल हो जाएगा, उसके बाद अभी फिक्स ही आएगा. Got it? Same example here also. Maybe he is receiving fixed from somewhere और उसको floating चाहिए तो ले यार वहां पे 1.3 मिल रहा है, वो यहाँ पे भी 1.3 देगा और बोलेगा मुझे जो फ्लोटिंग मिलेगा वो ले लूंगा. तो इफेक्टली उसको फ्लोटिंग हो गया, लाइफ में उसका फ्लोटिंग इज कंफर्म, which is what he wants because he wants exposure to floating. So he's not doing this deal just चलो मन आ गया करूंगा. He's doing this deal because he has another deal at the side where he's receiving maybe 1.3% on a loan. उसको 1.3 मिलता होगा, बोला नहीं मुझे 1.3% नहीं चाहिए, मुझे फ्लोटिंग चाहिए. तो यहाँ पे 1.3 देके फ्लोटिंग ले लेगा, उसका नेट फ्लोटिंग हो गया, फिक्स खत्म. अभी समझा कि नहीं? So these agreements are very useful for people to convert their business exposure from fixed to floating or floating to fixed. Now you got the logic? High level है ये थोड़ा. Clear or not?
Yes, sir.
Okay. अरे छोटेला, एक मिनट खोलना. And then we come to bootstrapping. Last thing we'll probably wrap up for today. तो लोड actually bootstrapping थोड़ा interesting थोड़ा आगे करेंगे because the rates are very useful. तो अभी मैंने जो अभी पूरा समझाया this is exposure को ही तेरा बदल रहा है to a completely different level. ठीक है? Yeah, I think I'll show this later because in this I want to show you in the calculator and show you how the coupon rates can be used to bootstrap. Okay, so I'll come to bootstrapping later through this. 1 minute. Huh? Yeah. That is the forwards. And similarly, I'll just quickly show you. Similarly, you can compute the value and price for future contract in the exact same manner because just remind me next week I'll do bootstrapping. I'll take half an hour. You know that forward is same as futures, right or wrong? Both are obligations, correct? Both are certain. In both you can't do much. What's the only difference? Forward is settled by delivery, correct? And future is settled by cash. That's the only difference. Baki sab same hai, correct? So therefore, the value of future and forward, answer is same. Answer is exactly same. There's a very small line difference. So जो भी मैंने तुझे अब तक सिखाया forward के लिए वही चीज future में भी आएगा. Look at the example. Future price क्या है? Same as forward. Spot into 1 plus R raised to T. Or spot minus, look here, benefit plus cost into 1 plus R raised to T. Or spot into E raised to R plus cost minus benefit raised to T. Same. To cost nikalo, benefit nikalo, right? Answer C. Obviously, when you do benefit, you have to take present value benefit. Okay. That is how you will value futures. Exactly as forward, nothing different. Okay. We look at the valuation aspect. Okay. Now, as you remember, I said that at the time of initiation of contract, the value would always be 0. It's only when the time changes that then the valuation would change because the underlying market price would also change. Okay. So, put it in context. Okay, at the time of initiation, it's 0, but after the initiation, the value of the forward price will not change, the value of the future price will change. Okay, the valuation changes only because the underlying asset price changes. Okay, and in futures, okay, remember in forwards, we have a contract and there is no mark to market. But in a futures, when you enter the future contract, you are supposed to be paying mark to market changes on a everyday basis. So per day, mark to market changes take place and therefore the mark to market cash flows are affected. Okay. So when you do a mark to market, effectively the price will reset to the settlement price. Now, how does mark to market work? Basically, whatever is the value, if the value goes up or the value goes down, that difference in the value is settled through cash. So cash is either paid or the cash is either received. That amount of cash payment or receipt is called as mark to market. Now, because the valuation change is adjusted through cash, effectively the value returns to 0. Right? Because you have already paid or received the value change. So the value every day will once again reset to 0. Are we clear? Very important statement. Mark to market gains and losses are settled every day. So the valuation is 0 on a daily basis for futures. Here, but for forwards, there is no mark to market. There is no cash pay received every day, and therefore the value will tend to keep changing as and when the underlying price changes. Okay, let's look at a good example of how to get the mark to market valuation changes. Now understand the various terms. I have 100 ounces. This 100 ounces is called the multiplier. Okay. And here's N. It is 1800 per ounce. Right? Now, because it is one contract. Okay, one contract. So I'll say N is equal to 1. Right? Each contract has a multiplier of 100 and each multiplier has a rate of 1800. So remember here I'm dealing with 1800 per ounce into 100 ounces into one contract. So one contract will have a $1,80,000 outflow inflow. Then we look at what is mark-to-market cash flows. Okay. Are we clear the three terms? You need to know what is N, which is 1, what is multiplier 100, and what is the price agreed at, which is $1,800. Okay. Let's look at how the valuation goes. Now, obviously on day 0, there's no mark-to-market value because we said value will always be 0. Now let's see on the next day, day 1, the value becomes 1,810, right? So that means I have a mark-to-market of $10. But don't forget, this is $10 per ounce. Each contract is 100 ounces and I have one contract. So I'm looking at $1,000 outflow inflow towards mark-to-market gains and losses on a movement of $10, right? Now this $1,000 will be added to the margin of the person who made the gain and will be deducted from the margin who made the loss. So the person who is gaining will get $1,000 more into his margin and this guy loses $1,000 more, less. Now let's see on day 2, the price has moved to 1,790. Now you no longer will look at 1,800, you will look at 1,810 because you already have said 1,810. Now your movement from 1,810 to 1,790 is minus 20, right? So minus 20 is nothing but 20 into 100 ounces per contract into one contract. So that gives you $2,000. Now this $2,000 is a decrease. So this time, this $2,000 will be a loss for the other person, but a gain for the person who shorted it. Yeah. So now my new futures price is 1,790. Now on day 3, whatever is the price, I will compare the price to 1,790. I will not compare it to the original contracted price. So you notice that in futures, when you're seeing the pricing, the original price is going to be effectively discarded, and every time you're marking to market to the new value as to the market price. And this price will continue to day 3, day 4, day 5, and so on. Clear? Okay, so this is called mark to market. Very important. It happens only in the world of futures. Any questions? Okay. Now, obviously, futures have a daily mark to market. So, if the interest rates are positively correlated, if the interest rate is correlated with the underlying asset, right? A long futures, long means you have bought, a buy. A long futures contract is preferred to a forward without MTM cash flows, right? Why would that happen? Because in a long futures, the interest rates are correlated, so you might get cash flows that are coming in. You prefer to have a cash flow mark to market when you're going to get the money, right? A higher rate when lending than when borrowing, right? You'll obviously want to lend at a higher rate and borrow at a lower rate, right or wrong? Okay. Now, there won't be major differences in price or values. It is only that in a forward, you are not doing any mark to market. That's the main difference. But in a future, every day there is a mark to market cash flows daily. So this is a big headache in the futures, and that is why it's dangerous to have a future contract where every day they might ask you to pay money or they might pay you money, but that's completely contingent. It's a huge risk, right? So therefore, forward is safer. A future is probably more risky in terms of cash flows. But a forward has a default risk. A future has zero default risk. Clear? So what are short-term interest rate futures? Now you know what the concept is of interest rate future we did last time, right? Interest rates. So an interest rate is where I'm agreeing on a certain rate. Basically, I might go for a fixed to floating, right? So my interest rate future is where I'm agreeing to convert either fixed to floating or a floating to fixed, correct? And if you remember, I taught you last time, I taught you the concept of FRA, forward rate agreement. The R here stands for rate. So this also is the interest rate future agreement where we have implied a forward rate and you're going to price it accordingly. Correct? Now, when I give you a FRA price or STR price, there's a difference in the way they annotate it. When they say FRA price, FRA, it means it's the implied forward rate. Okay, the forward rate implied, but on annualized basis. But when they give you short-term interest rate future, short-term, here you need to consider what is the value based on 100 minus, right, the implied forward rate percentage. So implied forward rate, let's say 3% would be 100 minus 3, which is 9. Clear? So the FRA price is the annualized implied rate and the STR price is nothing but 100 minus the implied forward rate. Okay. Now, the short-term interest rate, long party gains when the price increases. Obviously, because he's long. So as the price goes up, he will make more money. Correct? He is gaining only the price goes up. Right? Why? Because of, obviously, this means the forward rate has fallen. The asset price has gone up. He is long, he will make a gain. FRA. When does the FRA party gain? Now, FRA is basically, like I told you, it's a rate. So FRA is a rate. When will the party who has gone long on the rate gain? He will gain when the rate goes up. Right? So in a short-term interest rate, you're dealing with value. Therefore, he will gain when the value goes up. In a FRA, you're dealing with rate. So he will gain when the rate goes up. Are we clear the difference here? Okay, STRA deals with price. Therefore, the price should go up for him to gain. FRA deals with rate. Therefore, the rate should go up for him to gain. Here, price goes up, STR gains, rate goes up, FRA gains. Right? Because they both are playing in different underlines. One is playing with price and one is playing with rate. Clear? One is playing rate and the STR is playing price. So the name is suggestive enough, but here they said price, which is actually based on the rate. Okay? Right? And obviously long means the person who is taking the loan and paying interest. Right? So obviously the answer will be different if it is for a short. So please apply the logic. Don't try to study this part by rote. Right? Now, let's look at the way we interpret the two prices also. Okay? It's just a matter of how we present it. Now, let's look at this example. I have now learned the terms long. Long means I'm going to buy the underlying. Future means it's a commitment, which will be subject to mark-to-market cash flows. What is $1 million? This is the underlying. So I have agreed to buy $1 million, means I'm going to receive $1 million after 6 months based on the 6 months MRR, right? Which is priced at 97.5. Now, what is 97.5? It's nothing but, so remember 100 is the base. If I say 97.5, it means there's a 2.5% rate attached to it. Clear? So the pricing means that what is the discount amount, that is 100 minus that pricing. So here I'm giving for a rate of 2.5%. Therefore, it's called 97.5. Okay. Now each basis point change in MRA changes the futures contract basis point value. Okay. So I'm just looking at the way it's done here. It's probably a little bit longish. Let's look at the right way. Obviously, a little easier way to do it, right? You know it's 2.5%. So 2.5%, okay, is also equal to 250 basis points. You know that 100 basis points is 1%. So 250 basis points is 2.5%, right? Now, what is the value of 1 basis points? Now, you already know that this is a contract where I'm long. So if the basis points goes up, I'll make money, goes down, I'll lose money. Now, the question is, what is the money you'll make per basis point? Now, what is 1 basis points? 1 basis point is nothing but point what? So if 100 basis points is 1%, 1 basis points is 0.01% because divided by 100, right? Which means it is 0.0001, correct? In absolute terms, correct? Now this contract is for $1 million or a 6-month pricing. So let's look at the value. $1 million whose pay if my interest rate changes by 1 basis point, which is 0.001, and it is a 6-month contract. So I'll do into 6 by 12. Thank you. What will I get? $1 million pay 0.01% for 6 upon 12 months gives you $50. And that's only for 1 basis point. So if I have a 1 basis point change, I need to pay $50. Okay. Here. So $50 per basis point. You found out that important learning. Based on this, it's easy to now understand how much should I settle at. Now they're telling you MRR is 2.44%, right? 2.44%. What did you agree at? 2.5%. So simple, 2.5, but the MRR settlement is 2.44, which means there is a 0.06, which is nothing but 6 basis points, correct? 0.06% is all in percentage terms. So 0.06% is nothing but 6 basis points. We already agreed that $50 for 1 basis point. So what is 6 basis points into $50? So the payoff will be $300. That's clear. Clear? $300. If you want to do the traditional way, you can do that. You can find out the difference. The difference is 2.5 minus 2.44, which is 0.06%. What's the loan amount? 1 million. What's the rate? Differential. What's the period of the loan? 6 by 12. You will get exact same answer, 300. So if you want to know what is the payoff, you can do the maths by literally doing the difference into the value into the period, or you can find out the value per basis point. Find out ki kitna basis points move over. 2.44, 2.5 is 6 basis points into 50 will give you 300. Here, and also doing the basis point very simple. Remember to connect the dots. You can do 97.5 minus 8.56, or you could do 2.5 minus 2.44. You get the same answer, which is here, the payment towards the long position, right? By long, here we have a long future, correct? And here the rate was 2.50 and the market, the rate was 2.4. All right. So computing the amount is very important, and also finding out is it a pay or is it a receive is also equally important. Okay. That's how the forward and future prices will flow in terms of cash flows. Any questions?
No, sir.
Good. And note that your payoff is linear. When I say linear, it means it's a straight line. That's called linear. So suppose the interest rate is going up, right? The interest rate is going up, then the payoff will be a straight line. Itna interest rate pe itna. So it's not a curvilinear, it's a linear function. Why? Because it's related directly to the interest rate. As the rate goes up, the payment is going up in a straight line. What is convexity? Now, while you know it's a straight line, convexity is where the value may not be exactly same in a linear fashion. There'll be some payments which will be not directly proportional. Okay, it will be convex function. Example, let's come to you. Okay, let's understand this logic. Suppose MRR is 2.56, which is plus 0.06%, or MRR is 2.44, which is minus but 0.66. So यहाँ पे rate has gone up, यहाँ पे rate has gone down. Obviously, the rate goes up, the long is making money. If the rate goes down, the long is losing money. Correct? Now notice that in this case, when the rate goes up, $300, he will divide it by, obviously he'll discount it by 1 plus R upon 2 because 6 months, we get 2.96. So basically, the discounted value at this rate will be 296. The discount value at this rate will be 296.38. So what do you understand? I mean, potentially, when you take the rate differential as 0.06, it's more by 0.0 less. If I take the two rates, I should ideally get the same answer. One is, so if there's something, one is up, one is down. If I use as two rates, I should ideally get a similar answer for my present value, right? That's not the case, potentially. And it's changing and it's off by around 0.16. Clear? So what does that mean? That just because, so basically you will see the person who gained money on this gained, when the rate went up, he gained potentially 2.96. But when it went down, he did not gain the same amount. He gained something different. Okay. The payment to long, when it went up by 0.06 was 296. But the payment he ended up making when it went down, the same percentage is little higher, slightly again. It's not that's a great amount of difference. Thoda, matlab, it's like only 17 cents higher, right? But that is there. That's called convexity. Basically, that because you are not able to generate a straight line payment payoff. Okay, and that leads us to convexity. Yeah, what is convexity saying? The gain is always larger than the loss. When the interest rate goes up or goes down, the amount of gain or loss is always going to be different. They're also telling you that the gain is going to be always greater than the loss amount. So the principle of convexity is gain more than loss at same rate change. The gain always more than loss. Okay. Obviously, this convexity bias will have value. This is then bond convexity also, which you learned in fixed or instruments. Fixed income, remember there's a bond convexity where we said the bond potentially falls, but the actual answer is the bond goes like this. That's called convexity. The difference in payoffs is small for short dated FRAs, but significant for long dated FRAs. Yeah, obviously you will have the longer dated ones having more amount of payoff, and therefore you'll have the payoff differences there. Yeah, so I want to incentivize my people. Yeah, any questions? Convexity of our payoffs. The concept of convexity, are you clear with that?
Yes.
Okay, and convexity only that it is not a straight line, which you learn in fixed income as well, right? Now let's go on to the concept of valuation. Okay, because what we're doing so far is trying to value the items, we price and value. Now we'll go to this concept, but for other instruments like interest rate swaps, interest rates, and so on. Okay, so what's an interest rate swap? We discussed in forward rate agreement, so FRA. A fixed rate swap will pay fixed, right? And he'll receive floating. So that's a fixed rate. He wants to pay fixed and receive floating. Same way, a floating rate swap, a fixed floating rate pair, a floating rate swap pair will swap to pay floating and receive fixed. Clear? Each payment equivalent obviously to FRA at a fixed rate, which should FRA is the basis. Swap is equivalent to a series, okay, of FRAs at at swap fixed rate. So basically, if I have several FRAs put together, I'll get an interest rate swap. Okay, obviously same logic. At the time of initiation, the swap has zero value, but later the value may become positive. Yeah. So swaps essentially are nothing but a series of FRA. Yeah. Then you have fixed rate pair, we discussed here. It's like using a fixed coupon bond and using the proceeds to buy FRA. floating rate payer, okay, equal usually of FRN, and using a proceeds to buy a fixed coupon bond. Why is buy fixed coupon bond? Because he wants to receive fixed, right? He's paying floating. So what he'll do? He'll probably adjust and he'll probably want to receive fixed and get the floating interest. Clear? So interest rate swap is a mix of several FRAs. Remember that. That's how the cash flows are adjusted. Right? See this example. You have interest rate swap. The swap price is the fixed rate. So here he is agreeing to swap for the fixed rate. Right? Obviously, at initiation, everything is going to be 0. Right? So swap price is a fixed price. At initiation, you will do a contract such a way that 0. Then you have present value of fixed payments and floating payments. Right? You pay floating and fixed rate. You get floating rate debt. Right? Forward curve shifts up higher. Fixed rate will also be impacted. Okay. 1 year quarterly pay swap. We discussed this already. Correct. 180 day, 270 day, 360 days. These are the way a swap is basically mentioned in the PAR exam or maybe a FRA. Right. You have to look at these terms to ensure that you understood the right. Okay. 1 year quarterly pay. Why is quarterly pay? Because you pay it at the end of every quarter. Yeah. So these swaps are slightly difficult from the other ones. Slightly difficult, and you have to look at basically how they form. Okay. Now, if you want to price a swap, right? What would be a broad formula? If you want to price it, now look here. Let's say I have 3 instruments. The coupon rate is so much every year. Present value is so much, right? YTM and spot. Okay. Now I have different rules based on that. But if I look at fixed coupon government bonds, right? They'll be fixed, and the maturity period will be obviously different based on that, right? You'll notice here your PV is being affected. Clear? ITM is nothing but the yield to maturity on the total deal per se. Okay. So imagine 2.39 only getting, but you should have probably spent got more additional amount there. Okay. So annual coupons are different for each one, but effectively they come to the same answer. Any questions? And they also say notional principal, assume it to be 100. Normally you don't assume it, but it's saying usko 100 kar. Right? And you always have to have a notional principal when you do any swap sum. You have to have a notional principal, no choice. Clear? So, yeah. So let's try to attempt the sum using steps. Everyone open your book or your notes writing pad. And open that for a minute and read the sum carefully. What do you understand from this? The coupon rate. This is the nothing but the annual coupon or the interest rate you're getting on the bond. 1.5% on the 1 year maturity, 2.5 2 years, and 3.2% on the 3 year maturity. The present value of the bond, okay, the PV value. Obviously, assuming the $100 ka bond, the present value is 99, 98, and 98. What's the YTM? YTM means the yield to maturity based on the internal rate of return. So the YTM is 2.3, 3.4, 3.5. Obviously, you realize higher because the coupon is higher. More the interest, more the YTM. Now the spot price, okay, the spot percentage is 2.3, 2.14. Okay, the RC will compute the fixed rate for the 3 year. For the 3 year annual settlement for the interest rate swap, right? Now remember, it's 3 years interest rate swap. Okay, they're not asking long or short. All they say is find out what would be the fixed rate. You know the fluctuating rate here. I want to know what the fixed rate would be. Okay. Now look at the way we do this potentially. You have 3 types with 3 different years, right? I should show it together. Yeah. So what you'll do, since you have 3 different time periods, right? for each time period. So when I say 3 different time periods, I'm looking at if I'm in year 0, year 1, year 2, and year 3. Okay. Now for 3 different time periods, I'm looking at 3 different types of bonds. Correct? Now look at the time period from 0 to 1. Okay. From year to year and from year to year. Now understand the rate. I have a spot rate. Remember spot rate as of today. Spot rate for year 1 is 2.396, right? So if I invested $1 here, how much will I receive here? How much will I receive in year 1? I'll receive $1 plus 2.396 percentage. So $1 and 2.396. This is in year 1. Here. Now in year 2, what will I receive? Okay. Now in year 2, I'm earning 3.4197. So my year 2 will be 1.034197. But this is a rate that I'm going to be paying up based on that, right? For 2 years. So I'm going to look at 2 years because this is per annum. Don't forget it's per annum. These are per annum rates. So I'll pay this for 2 years. I'll do this to 2. Right or wrong? Now let's look at year 3. 4.0005. So simple. So again, 1.040005. Yep. And this is for what period? This is for 3 years. So it's 3. Got it? So for 1 year, I'll learn 1.02396. For 2 years, I'll learn this much square. And for 3, I'll learn this much raised to 3. Yeah, any questions? Okay.
No, sir.
But you got this aspect, this understanding is there based on spot rate. Now the question is this. Suppose I want to equate this to this. Remember, this is 2 years, but this is only 1 year. I need to also consider what I get in year 1. So 0 to year 1, year 1 to year 2 is equal to year 2 ka rate. So I'm earning this much in 2 years, and here I'm earning this much in 1 year. How much am I earning in the second year? Right? That will give me no arbitrage. Right? So amount that I've earned in this year is equal to whatever the rate is in that year. Correct? Whatever the rate would be for that year. Okay. And I will do obviously 1 plus RS. And so this is year 1 to year 2, right? Year 1 to year 2. So year 1 to year 2 is only for 1 year. And I'm doing minus 1 because I only took plus 1 out here. Potentially. Right? Now look here. Right? 1 plus R. Right? But I don't know this 1 plus R. I don't know that. So therefore I'll simply say 1 plus R. Clear? I don't know for year 2. Here I did 1 plus R for 2 years. Right? Square. 1 plus R 3 years. Okay. Now here I did this into an unknown. Same here. I'll do this amount, but I don't know this amount. So I'll do 1 plus R. It's an unknown. Correct? It's an unknown. But it's an unknown for which period? For obviously 1 year. This also for only 1 year. Unknown for 1 year. Clear? Okay. So let's look at the diagram. This much and the unknown for 1 year. This much is for 2 years and the unknown for 1 year. Okay, and this much is for 3 years. There's no unknown because it's entirely ready for 3 years. But don't forget to take the 3. Okay. Now, because you have unknowns, it's easy to connect the dots and find out the missing unknowns in the entire equation. Can you find out the unknowns would be? I explained that earlier. Okay. Now, you have this, which effectively is using this, right? The rate was 2.396, correct? Now, if I want to find out what is this rate, how will I do that? Okay, I can find a spot rate, okay, for that period, and obviously this is for year 2, and this is for year 1. Okay, so if I do 1 plus R raised to N, okay, upon, now this is R2, upon 1 plus R1 again raised to n. Okay, and don't forget you want to remove the 1 at the end of it potentially. So what do you get? You will get an answer which is the implied 1 year rate. Remember, I'm taking the 2 year rate here and the 1 year rate. So if I consider 2 year rate and 1 year rate, I'll get an implied 1 year rate for the intervening period. Okay, this is the amount. If I take this and this, I know the answer should equate. I know how to find out this rate by using this formula. Here, the implied rate, and that's what I said. Find the implied rate for each settlement period. Here, here is 03, 02, so it's more, 04, 06, so it's more. Okay, all you have to do is take the spot rate of the higher amount divided by the whatever number of years and divide the entire thing by 1 plus. Here. So this is a very tricky situation of how to find the implied rate. When I give you your 0 to 1, 0 to 2 and 0 to 3, you can find out 0 to 1 plus 1 to 2 is my answer, right? 0 to 2 and 2 to 3 is also my answer, and this is 0 to 3 completely. So, right? So 0 to 1, 0 to 1 and 2 to 3 and 2 to 3 to 3. Okay, and you'll notice the answers are potentially going to be higher. 2.39, 4.5, and this is 5.17%. Here, this is how you find implied rate. Very important concept. Please learn it because it's not just time consuming, it's also a little bit tricky. Clear? Okay, so here the price swap with solutions. Okay, prices swap steps. This is another example where we're trying to compute the floating payments. Okay, so here you found out what the rates would be for those periods. Okay, now if you remember, there's some, yeah, I'm getting the rates that were given to you for the floating period. Okay, so remember the rate was, here the rate was 1.02396, right? So I'm going to earn this interest in the first year, this much in the next year. Here, effective rate. Okay, now we need to understand what would be the implied rate for the intervening period. Clear? But that help you decide the answers, right? So once you get this for the floating rate, floating. So the floating rate would be the rate that is changing. Correct? Which will be confirmed by the amount. Here. Okay. And you're obviously getting these rates from the information that is given to you. Okay. 2.396, 4.4536, and 5.1719. Right? Any questions? So you can use the swaps to basically find out what is the implied rate in the market. Swaps are a very good tool to find out what is the implied rate in the market based on that example. Here, obviously zero arbitrage fixed rate you can compute using that. Find out what's the fixed factor that gives you no profit no loss and then get it. Now, quickly, if you want to see how to value a swap, I taught you some parts of this last time. Basically, a value of a spot swap is based on the amount that you're giving, right? Because. Okay. Now, you know that once you enter interest rate swap, the person who is a fixed rate will pay the amount he fixed minus the differential amount, right? Okay, so that's a swap case. So obviously, the fixed rate payer will pay the differential amount on the interest rate agreed and the market interest rate, but don't forget that's based on actual principal into N upon 12. Very important. Yeah. So if I have a fixed rate payer, the other guy obviously is a floating rate receiver. So remember, one payer will have one receiver. Okay, so this is the way you will understand the concept and try to compute the sums, break down timeline 0, 1, 2, 3, and make sure you are able to with the answers. Okay. Now you guys, again, as usual, we normally do a quick question answer round. Tell me what's the answer according to you guys. Quickly. Here are the options carefully.
So the balance sheet one would be the issuers.
Okay. Good.
The exposure profile, interested exposure profile would be the investors because they would obviously want to uh, reduce their risk exposure.
Okay.
And the third
So
one would
so you're saying specific balance sheet liability to transform the interest rate expo profile is issuer. Okay. Fine, because the liability. Okay, fair enough. Users
and
to and just expose without buying mostly underlying securities. Okay. So you're saying B is for who? Both or only investors?
no, only wait 1 second.
Hmm.
Only investors.
Okay. So they are just seeing the profile without buying or selling underlying securities. Okay, fair enough. And this one is both, right? Because this is the extreme what is swap. A swap is cash flow. अभी सबको वही आंसर रहेगा, right? अगर swap cash flow है तो सबके लिए या invest होगा, issue होगा. He will have the same understanding of a swap, right? Effectively, correct? So the answer.
Yes.
And yes, yeah. And balance sheet liability obviously is making sense because that guy is a issuer. Very good. Well done. And that is indeed the right answer. Issuer as a liability. Investor will have to make sure that he's buying the specific stock. And a swap is the same answer for both issuer and investor. Swap works. Okay. Very good. Well done. Really well done. Let's look at the next question.
So I think the A1 would be fixed rate payer because they are establishing a set of certain net future cash flows.
Net future cash flow on a swap contract. Okay. Fine. Okay. Realizes MTM gain on swap if the exit future floating rate payments increase. If the floating rate payment increases, what will the gain be? If the floating rate payments increase. So who will earn if the floating rate payments increase? The floating rate payer or the floating rate receiver?
So the floating rate receiver.
Okay, makes sense. Very good. Yeah. Because the floating rate is going up, so the receiver receives money. Good. Investor may increase portfolio by increasing this position in the swap contract. He may increase the portfolio duration. Okay, so net future capital on a swap. Makes sense? Is this correct?
Yes, sir.
Because this can't be neither, right? This has to be one of them. And this is the right answer. So this one and this one is he may increase by entry into the portfolio swap contract. Right? It may increase portfolio duration. Okay. So duration, yeah, obviously duration cannot be touched by a receiver pair, by an interest rate swap, right? A duration is not something that can be tackled broadly, correct? Potentially. Okay, but there, this is different, surprising. I'll check the answer. I don't think this is right because obviously the gain is within floating rate. That's correct, right? They're saying duration can be done by fixed rate receiver. Duration of a contract can be increased by a floating rate pair. That's surprising. Okay, I'll just take this one specifically later. I'll come back to you on that. Okay, the last one. All right. So so just to quickly recap for a minute before maybe we'll just pause there and then come back to options. Options are different beasts. You'll have to make sure you learn that carefully. Yeah. So what we've done so far is we looked at how to price and value the futures and the forwards, right? And more importantly, how to get the valuation right in that regard. Clear? And we also looked at how to get the differences between future forward and the pricing of future forward and the valuation, why they differ in the first place. And what are various factors which will affect the future and forward valuation changes. Okay, so the value of the future forwards, the pricing, the content, so on. Little limited stuff probably. Okay, Now, as we move to next chapter, this will totally blow your mind because here we're looking, obviously, sorry, we did swaps also, interest rate swaps, other swaps, we did how the swap can be checked with other instruments. Okay, now as we move on to the other ones, we are particularly going to look at what is the rate out here. Okay, an interest rate swap. In an interest rate swap FRA, you have certain swaps that will be paid on a periodic basis. Correct? We had some good questions we did, and now we'll move to valuation. Now, we'll just pause here for a minute. If you remember, I taught you valuations, and in that I taught you we had call and we had put. But the person who has the benefit of all this is who? The person who is long, right? And the other guy has the obligations. So call and put. If I tell you, boss, this is my exit position, please value it for me. You'll have to conserve a certain valuation. Now here, it's not as easy as pricing. Teacher or pricing for the value. Here you have to find out the value based on the underlying and the number of days. Clear? So we look at certain concepts here, like expiry value, moneyness, time value, and so on. We look at arbitrage, obviously, and the value and option. Let's quickly look at the moneyness part and then we'll take a break. Right? Okay. Now, intrinsic value for is nothing but the hardcore value. Okay. Intrinsic value. This value of put is equal to the hardcore. Right? Difference. Now, the intrinsic value is nothing but the difference between the market price and exercise price. But why they said maximum? Why they say this? Because no negative, right, answer. You don't want a negative answer because an option, the moment you have a negative answer, you are out of the contract. You will not bother to exercise it. Yeah? If the contract is in the money, then what? Okay, exercise value is amount retained money, but intrinsic value and P of F family. Okay. Now this is important concepts. In, at, out. I told you last time at the end. You are in the money if you're making profits. You are at the money if you're making no profit, no loss. Right? And out is on the faltu. Like you won't make any money if you execute. Here if you execute, you'll probably make no profit, no loss. Here you are not going to execute. Yeah. And so you should understand what in the money, at the money, out of money is from a call option and a put option. In a call option, obviously you want your exercise price, correct? And you have this. So you have to look at what the difference between the two and look at it from a call point of view and from a put point of view. One good news is that based on that, the amount can be changing, right? So in, at, and out would be variable. Clear? That's how the intrinsic value of an option can be computed. Intrinsic value, not the intrinsic value concept, is the basic value. The basic value based on basic formula. Clear? Okay. Okay, so on that note, because the next part will take a proper 1 hour without a break. So on that note, let's pause here because valuation of options is the most important and there are certain techniques to know that. So let's do that later after the break. Okay, let's do this sum. I'll try and get the answer sorted. Either sum. I have a 1 year put option. Exercise price is 1,000. The risk rate, which is discounting, is 1%. And they're saying, what is
Sir,
the...
can't see the annotation.
Okay, wait, I'll come back to that. What is if the spot price is $950? What's the मैं वहां से चेक किया बट वहां से नहीं चल रहा बट पता नहीं स्टॉप हो गया तो निकाल दिया वहां से निकाल दो नहीं अभी निकालता हूं बिकॉज़ यहीं पे एक मिनट रूम यहां से चेक करना टीवी से देखिए ओके 1 minute what will be the put option exercise value okay now see let's look at like this timeline 0 is today they say it's 1 year later so 12 months exercise value of the option in 6 months. If the spot price is $950, so remember exercise price is $1,000. Spot price after 6 months is $950. Okay, euros. That's fine. What will be the put option exercise value? That means what is the value of the option? Uska value kitna hai? Agar you can buy it for, you can sell it for 1,000, it's a put. I can sell for 1,000, but the value is only 950 today. Now remember, the key point here is the discounting factor. I will sell for 1,000 after 6 months, right? After 6 months. So value is how much? 6 months back. Clear? So I have to consider discounting aspect. 950 is the spot price. Now obviously you realize it's in the money, becomes selling for a higher price compared to 950. So in the money is fine, I'll give them value, but how much value will I get? Okay, you know the concept of discounting? Right or wrong? Correct? So without seeing this answer for now, just think of it. What's the value of $1,000 here? You know the answer. 1,000 divided by 1 plus R raised to N. Correct? So 1,000 divided by 1.01 raised to 0.5. This is the value of $1,000 today. This is the value today. The difference between this value and this value is equal to the value of the option. Clear? The difference between this value, present value, and the current spot price is equal to the total value. Any questions? Can you solve the sum once? The way I just showed you. Solve it in this style using the timeline. $1,000 is worth how much today? Okay, so that probably comes to 994.96. No, 995. 995. Okay, approximately 995. Approx. 995 is the value of $1,000. 940, 950. So the difference is 45 euros, and therefore the value is 45 euros. Is that clear? Check your calcs, guys.
Yes, sir.
Got it? Clear? Now, we'll do some on that. Now, just broadly concept of commitments and contingencies. Now, obviously, a commitment is something that you have to pay. You can't, it's an obligation. You can't back away from that. So that's a commitment, which is normally there in forwards and futures. But a contingency is something that I don't know whether it's a payable. I'll come to only when a future uncertain event is going to happen, not happen, right? So in a commitment, basically you have symmetric payments, payoffs, and obviously you have unlimited gains or losses. So this is the forward. You have no value on initiation. You will have symmetric payoffs, and the payoffs could be unlimited. But a contingent commitment, contingent claim, right? Effectively, because contingent, you have some positive value and payment type assurance. You have to pay something. The payoffs are asymmetric, not symmetric, like life insurance contract. It is asymmetric. You don't know when the payment will happen, how much, but it depends on the age and other factors. And there's a maximum loss and a maximum gain for this. Unlike here, where there's unlimited gains and unlimited loss, a contingent claim has a maximum loss and a maximum gain. So this works more like an option contract. Correct? Example, life insurance cover. You saying you're covered for 4 crores, right? You will be paid only that much. If a person dies, he'll not get some 20 crores. There's a maximum loss and a maximum gain also, which might be the amount of premium you paid. You may get that amount back. That's your maximum gain. If the person survived the contract, he'll get the entire amount of premium back. Here. So these are my concepts of what's a forward commitment, no value when you get unlimited gains or losses, but contain claims like insurance contracts and options. You have maximum loss and gain, and you have some value at issuance, which is called a premium in the terms of option contracts or life insurance contracts. Yeah. So get the difference right and understand it very carefully. Okay. All right. Let me see if we did this. Yeah. Okay. Now, let's look at valuation for contingent claims, right? Because we have an upper limit for contingent claims. There's also valuation given to it, right? If it's a call, okay, if it's a call. Now, for a call option, right? Now, remember, call means the right to buy, right? The minimum value, remember, will always be stuck at 0 or the difference between the spot and the exercise price. Correct? That's a minimum. And the maximum value that you can go is the stock price, because remember, no stock price can go below 0. Correct? Put option. Again, you have the right to sell. So the value that you can earn minimum is either 0 or the price minus the spot price. But what's the maximum value? Now, maximum means the right at which you can sell the contract at the time of maturity. Correct? Which is X. Right? So you will buy it at a maximum value of the stock price or sell it at the maximum value of the excess price. But minimum value will always be mostly 0 or the lower value. Clear? Now, or the 0 or the value which is computed. Clear? Now, option price. What is the premium you will pay for taking an option? What's the premium? Obviously, you're going to pay a premium which is equal to your current payoff. मतलब आज के आज कितना फायदा है ऑप्शन में? How much is it in the money? That is the value you usually pay plus time value of money. Let me explain this concept to you a bit carefully. The premium you pay, you'll often wonder, यार premium कितना pay करोगे, right? You will pay two things: the current payoff and the time value. Let me explain that. Let's say I have a call. The call is at, let's say, $15. Now the stock price in the market is $55. ठीक है? So मतलब आज के आज, if you exercise this call, you are going to make straight away $5. Right? Because today only you're going to make $5 profit. Plus, let's say I want to do a 1 month contract. That means in the next 1 month, this 55 might become 60 or 65. If it becomes 65, you'll earn $15. If it becomes 70, you'll earn $20. So this time value of money in next 1 month, कितना ऊपर चढ़ेगा पता नहीं, that might be, let's say, $12. Means you expect that this might go up by say $12. So the time is 12. That means you have to pay a total premium of $70, which is nothing but $5 current payoff and $12 time value of money. Clear? That is called current payoff plus time value of money. Let's see another example. Let's say I took a call at 50, but the market price is only 45. Now you tell me, useless it is, right? Why would you buy it at 50 whereas market price is 45? So can I conclude that your payoff will be 0? Because I'll earn nothing from buying 50, I'll buy 45. But there is a time value. The time is 1 month. In 1 month, it might become 52, 53, 55, 57. That time value for all you know might be $12. So in this case, I'll pay $12 premium, where my current payoff is 0, but my time value is 12. Here I'll pay $17 because current payoff is already 5 plus time value is 12. So basically, I need to compute two things. आज के आज कितना payoff मिलेगा plus future का time value क्या रहेगा, right? Now time value you're saying is $12 because your market is steady. But what is election time? पता नहीं कि कौन सा कंपनी ऊपर जाएगा, कौन सा पावर में बीजेपी होगा, कांग्रेस होगा, or which rules will come to play. You don't know. So maybe there's more fluctuation. The time will have more value, and this may not be 12. It may be 20. It may be 30. So this time value of money also depends on the market conditions. Clear? So all in all, there are two reasons why we pay premium. One is the current payoff, which might be 0 for all you know, and second, the time value, which is greater in terms of higher maturity. अगर तूने 1 साल का contract लिया, तो time value तगड़ा रहेगा. If you take only a 1 month contract, your time value might be much smaller. Clear? So time value is very costly in such cases. All right. Now let's look at this example. Okay. Now similar example. Now you need to tell me, this is very interesting. What is the time value portion of the contract? Same sum I solved with you earlier, but now you answer time value kitna hai? Obviously you already found out the value. The value को strip करो into payoff value and time value. What's the value? We found out 100. We already found out 45 in the earlier sum, right? So that means 950. So the value was 45 which we computed. इसमें से कितना पे ऑफ और कितना टाइम है? Current put option price is 50 euros. Try to attempt that. Tell me what you think the answers. Answer, guys. Let's look at this. Okay, we do the sum. We said 0, 6 months, 12 months, right? We look at this one, $1,000. So what we said, let's find the present value and minus the stock price, correct? So you got the answer as 955, correct? Which is why you said 45 is my exercise value. Now 45 is my exercise value, correct? So this being my exercise value is effectively nothing but my payoff. What is the payoff if today I exercised it? 950,000, correct? Today I exercised at 950. Sorry, and the market is 1,000. So if I bought it today at 1,000, I will have a payoff of 50 euros, right or wrong? Ask me how much. If I exercise it, I will have 50 euro payoff profit. That means if 50 is a payoff, out of which exercise value is so much, which is the value on exercising by looking at the current price, the time value is effectively the difference, which is 4.96. Why do you think even those $50 still paying that amount? Because effectively you're paying $50 because the exercise value is 45 and the time value is 4.9 or $5. So that's how we get the time value component of the put option, find out the immediate gain, find out present value gain, and the balance amount is your time value of the contract. Now you do realize time value is nothing but the discounting factor. So जितना तुम discount करोगे उतना तेरा time value बढ़ेगा, right? So answer is 4.96. Yeah, based on that. So you can find the time value using that. Okay, look at this example. Option value. Tell me what you think is the answer. Call option is 3 months. Okay. Exercise price 50. Risk-free rate 2%. Underlying price 57. It's a call, so you have straight away profit of $7.5, right? Call option price is £10. Which of the following has showing the correct exercise value and the time value? Answer. Now you know that the premium here is $10. That's obvious, right? 10, right? Now this 10 is broken down to exercise value and time, right? What is the exercise value? Exercise is nothing but 57. Remember, 57 is the current price, and you can you are exercise price of 50. It's a call option to buy, but 50 you will get after how much time? 3 months. So 50 upon 1.02 raised to 3, correct? Minus 57.5. This is the benefit you will get today. I mean, don't change signs of money, right? So you will realize that if you find out what's the value, right? 50 you can buy it for, but after 6 months. So today's value is how much potentially, correct? You'll notice that the difference is not 7.5, it is 7.75. So the exercise value is 7.75. Time value is 10 minus 7.75. So it will be 2.25. Because time value is nothing but the difference between the option value and your exercise value, right? Because the subsidy component. So 10 is given to you, find out 7.75, it will be the third answer. Answer is option B. Now, obviously, one more trick in the exam. This can't be right. Okay, between these two, you know that the answer can't be 7.5 because there's a discounting involved. If there's no discounting, it will be 50 minus 57.5, 7.5. But there is discounting, so answer is 7.75. There's always going to be discounting, so remember, this plus it should be equal to 10. But if the answer is this, then it's this. If it's this, then it's this. Clear? That is your option plan. Any question on this? So this summarizes the key learning that premium equals to exercise value plus time value. Clear? Take a note of this quickly. Get this concept very clear. Any query in this? Okay. Any question, guys? Please answer.
Can you give me a minute? I'm actually solving.
Yeah. Just solve it in this way. Told you. 10 is given to you. Solve the exercise value by finding present value. Do you want to know how to do in the CAPC? Same sum?
No, sir, it's okay.
Okay. You can use those buttons, the discounting factors.
So,
Yeah, go on.
so for the exercise value, I'm getting an answer as minus 10.37.
No, how can you get 10.37? What is exercise value formula? It is the max of 0 or x minus s, right? Because this is put, but x ka bhi, I will take what is the present value of x minus s. So either be 0, you can't get minus, answer can't be minus. And don't forget it's a call option. So it's a call option. So ulta, max of 0, right? Or s minus pvx, because it's a call option. Now 0 is the answer, or what is stock price? 57.5. Correct. What is present value of x? 50 divided by 1.02 raised to 3 by 12. That's your answer. If this is negative, then you jump to 0. That's the formula for exercise value, right? We learned it. Is the max of 0 or s minus x. And that's where you take out here. Okay. See, I explained to you this timeline. You are going to pay, today it is 57.5. You are going to be 50 after this time. So what's the value of 50 if we have to 6 months? What's the value today? The value of 50 today is 1 upon 1 plus r raised to n. That's the value. And this is the value in the market. So it's cheaper for you to buy it at 50, today's value, and get the benefit with the market value that comes to 7.75. That's the benefit you're getting from exercising the contract right away. Contract enter के exercise किया, profit बना 7.75. फिर भी तुम 10 क्यों दे रहे हो? Because the balance 2.25 is your time value of money. Got it?
Yes, sir. So
Any questions? Got it? Perfect. Good.
Yes, sir.
Good. So see, that's the answer. Okay. So if you forget, think of the two formulas. Call option is stock minus exercise price, and put option is exercise price minus stock price. But dono mein you will take exercise price as the discounted value. That's it. And that's exactly a formula I showed you here once again here. See, what is put option? Oh, what is put option formula for this? This is this. This is exercise value. This is time value. This PVX minus ST is the put option, and call is ST minus PVX. उल्टा. बस ये याद रखना. ये मिलेगा एग्जाम में, ये कंप्यूट करना है, and this is the balancing figure. That's all you have to think of. Clear? So let's understand. Now this is very interesting. It is not so difficult, but understand the logic. Okay, understand the logic, then we'll get the answer. Very important summary, guys, because this is often asked in multiple choice, and trust me, more than half get it wrong. Okay, let's focus on one. Let's focus. Call. Now what is call? Call is the right to buy, correct? Now that means you want to buy something, so you want to buy it cheap, correct? If the underlying asset price goes up, अभी तुम खरीद रहे हो, तेरा price fix हो गया, और ये price of the shares goes up. तो you are buying at a cheaper price. और price market में बढ़ रहा है तो फायदा ही है. Your value will go up. Correct? If the exercise price goes up, now you are going to buy at 100. Let's say now you have to buy 110. Obviously, you're not fool to pay more money. If your value goes up, then the call value will fall down. Clear? One more way to remember is like this. What is call value? S minus X, right or wrong? If the stock price goes up, then the value will go up. If the exercise price goes up, the value will go down. समझा कि नहीं? S minus X है, S ऊपर गया तो V ऊपर रहेगा, X ऊपर गया तो V नीचे जाएगा. So A going up goes up, but exercise price goes up, goes down. Clear? Now volatility is something where time value is always high. I said the elections are there or anything uncertain. Volatility will always result in an increase in value. It will always give a high value because volatility is the premium, right? Now risk-free rate. Remember I told you that you will discount at risk-free rate. What will you discount? X. So if I'm discounting X at 1 plus R, right? अगर risk-free rate बढ़ा तो discounting बढ़ेगा, ये value घटेगा और ये घटा तो ये value बढ़ेगा. Right or wrong? If discounting rate goes up, this value will go down more and this value goes up. So therefore the answer is goes up. Clear? If the time goes up, obviously you know the answer. Time to maturity always will increase the value because more time means more time value. Correct? And obviously better for holding the asset. If it's a call, there's no benefit because holding the asset will probably give you dividend and the value will go down. Clear? Cost of holding the asset, obviously there's a cost because you are holding, so it's storage भी आएगा. Here, so these two are a little off the track right now, but that's for you holding the asset physical. So quickly, call me. If the stock price goes up, value goes up. If the exercise price goes up, value goes down. If the discounting rate goes up, this goes up, this goes down, this will go up. If the volatility goes up, it's always up. And time to expiry is always up. Clear? Now let's do put. Put is what? The right to sell. And right to sell also has a formula PV minus S. So basically X upon 1 plus R minus S. That's the value. So let's come back. If the asset price goes up, obviously formula देखो ये ऊपर गया तो मेरा value नीचे जाएगा. But if this goes up, then this will go up. Got it? The answer is opposite because the formula is opposite, right? Volatility always is high. But if the discounting rate goes up, ये ऊपर गया तो ये नीचे जाएगा और ये नीचे गया तो ये भी नीचे जाएगा. So the answer is negative. Clear? Because the discount rate is on the first part. Time to expiry, I told you the answer for both. So remember two things. Time and volatility. Both of them will always have a positive effect. The other three will have a ulta effect. यहाँ पे plus है तो यहाँ पे minus, यहाँ पे minus plus and here plus. Sorry, and here plus minus. Here. So volatility will affect everyone positively. Time will affect positively. Stock, exercise, and risk-free rate will have different effects. Don't ratify. Try to think of scenario. Think of my formula. It will save the day for you. Clear? You should know at least till here the 5 scenarios, and they'll likely ask you what is the effect of risk-free rate and let's say exercise price on call and put option. They give you 6 options because they give multiple choice. You have to choose the right answers. Clear? Any questions on this? If you guys take a minute, put the formula down and try to connect every point to formula. Asset price, either आएगा. Exercise price, either आएगा. Risk-free rate, either आएगा. Try to connect the dots, you will understand it better. Clear? Can you make a note there? Any question?
No, sir.
Okay, sure. Good. Let's move on now. Okay, now, this is why I said they'll off in one beta. Then let's put call pat. Okay, sure. So, use this understanding and tell me, take your time, what's the answer for A, B, and C. Okay, just mark, give me one, just comment. A1, A2, A3. Right, what's the answer?
Yes, sir.
Low
So
excess
A
price.
would
If the exercise price is
That would
low,
be
huh?
increases the value of a call option. I would
Okay.
prefer buying an option with a low
Because
price.
call option value is S minus X, correct?
Hmm.
And if this goes down, the value will go up. Chalo, very good. Very good. You can buy cheap. Lower underlying price will
Increase the value of a put option.
good because it is X minus S. ये कम हुआ तो value बढ़ेगा. Very good. And rise in volatility will affect
Increases both.
Very good. And apart from volatility, there's one more thing which will increase the value. What is that? Volatility and what else? Increase the value.
Of both.
Yeah. Because value is based on two things, right? The price is based on two things. Exercise value and what are the other values?
Underlying stock.
And what else? Premium. Premium is based on two factors, right? One exercise value, which is this formula.
Time to expiration.
Correct, very good. Time value. So volatility and time to expiration दोनों साथ में होगा. ठीक है? Both will increase it. Here. Okay, good. That's the answer. Okay. Now we look at trying to find out options where we can use to replicate our strategies. Okay. So the very important concept called as call put parity. Okay. Call put parity. This is the last part of this point. We will move to another later. Now, what is put call parity or call put parity? Now, this formula is very important, but more than a formula, you have to learn how this formula can be used to find the missing numbers. Okay. Put call parity. Let's come to a concept. Okay. Now, put call or call put parity jo bhi hai. Now, put parity refers to a situation where I will get a protective put and a fiduciary call or a covered call. Correct? And what this is, I can use this two to equate each other. Okay. Now, basically, let's go a step back to broadly tell you how does put call parity. Okay. So let's say I want to find out, let's say I have a stock which is worth $100 and obviously and let's say exercise price of also let's say $100. Okay. You want to buy the 100, obviously time value to rahega. What will be the call price and the put price? What will be the option of the call and the put option? Right. I do realize if the carrying value is 0, that means call and put both will have some value because the values are based on time value of money. Now, these two concepts can be equated by using call put parity. What is call put parity? Let's look at the situations. Okay. Call and put. Now, let's go to call. A call is nothing but the right to buy the share. Correct. Now, if you want to buy the share, the amount that you're willing to buy it at is called the exercise price. That amount you should have it with you today, right? अगर मुझे एक share 100,000 खरीदना है, after let's say I took a 3-month option to buy it at $100, I should put $99 aside for 3 months, which will become $100. And after 3 months, I will sell that FD, get $100 and buy the shares. So you agree that if I find the present value of $100, which is effectively, let's say $99, that money will give me the shares. This position is nothing but a covered call where I bought the call, I put the money and I got the shares for $100. $100 में मुझे share मिल गया. Right or wrong? Because I bought a 100 got this and I took the money aside. Now come to the put side. Suppose I have a stock with me. मेरे पास एक stock बैठा है. I bought the stock for whatever. Let's say I bought it for $90, but or 95, and I want to make sure that I get nothing less than $100. So I'll go and buy a put. When I buy a put, and let's say $100, तो मतलब ये stock protect हो गया. ये stock 100 पे ही बिकेगा या फिर 100 के ऊपर. ये stock 100 के नीचे नहीं जाएगा. So the value of this position, right, is where I bought a stock at whatever price. I am protecting my stock by use of a put, and that's called a protective put. Protective put, a put that is protecting my stock. Protective put. Is that clear? अभी इससे भी क्या हो गया? मेरे पास एक स्टॉक है जो 100 में बिकेगा. मेरे पास एक स्टॉक है जो मैंने 100 में खरीदा. Right? Obviously, I hope you understand that both cases, my stock and exercise price is $100. Right? I have a stock, I purchase 100 no matter what. I have a stock, I'll sell 100 no matter what. This is equal to call put parity. Clear? So basically they're saying I can use the call put parity logic to find out the call option price when X is given, S is given, P is given, or to find out the put price when S is given, X is given, P is C is given. So call put parity has to find out, like I told you here, if I know that this and the call price is around 4.5, then I can use a call put parity. I can replace S here, I can replace X here, I can replace C here, and I can find the missing number. P might be 4.8 maybe, right? You can use the parity to find out what is the value of the call and the put option when the strike price, stock price, and exercise prices are given. That's called call put parity. Clear now? What is this side? Covered call or fiduciary call. What is this side? Protective put. Formula here, C plus X का present value. X is the exercise price. Formula here, stock plus P, because it is protecting the stock, protective put. Clear or not? Okay. Make a quick note of this if you want, just write down. So you understand the terminology and the way we get the formula. That's more critical. How did we arrive at the formula?
Sir, but won't this change the maximum and minimum values of the call and put options which we studied earlier?
No, this is the value at the initiation of contract, not at the expiry of contract. This will help you find out that when I enter into such a contract, what should be the value or the premium I should pay for it. This will find out that for you. It will give you the contract premium pricing of the option. What's the premium you should pay for it? That's what it's giving you. It's not giving you the valuation after you entered the contract. Clear? The value that you're referring to is the value after the contract is entered into. Then you'll find out ki bhai kitna value hai, what is the maximum of, because then the value will change based on the underlying stock price. S minus X or X minus S. Agar stock price ऊपर नीचे गया, तो value हिलता रहेगा, right? But what I'm trying to find out is simply the value at the date I wish to enter into a contract. That's it.
Okay, sir.
Okay. So when I use a put call parity model, okay, and I can look at screen, I have, like I told you, 4 positions. One is a long call and a long bond. Bond is nothing but excess price. जो मैंने आज पैसा दिया और मुझे $100 बाद में देगा. This is the excess price of the bond. And protective put, I have long put and long stop. This is where we being protected at the protective put level. Yep. Obviously, this parity has to work. नहीं तो लोग arbitrage करेंगे, and therefore arbitrage opportunity become possible. Clear? We'll put an example, but quickly synthetics of this. What is put call parity? Therefore, It is an option, formula where we say call price plus XPV is equal to put price plus stock. This should always work. If this does not work, people will do arbitrage and make millions of money. What is call? Okay, which means that call price, so उसको उधर लेके जाओ. Call price equal to P plus S minus PVX, right? उधर लेके, or put price equal to C plus PV minus S. Got it? So I can help you to find the call price using the put price or put price using the call price. Clear? It also means stock. अभी stock इधर है, तो इसको उधर लेके आओ. Call plus PVX minus PO. So you need to or restrieve bond. That is, this is equal to P plus C minus SO. So you can change the signs how you want. If you want this number, move this here. If you want this number, move that here, and so on and so forth. Okay. That is the last thing to understand here. Now you notice यहाँ पे plus है, but यहाँ पे minus है. Whenever you see a minus sign, it means, what is it meaning? Short. It means you have shorted. तो अगर मैंने इसको माइनस किया मतलब मैंने उसको बेच दिया, शॉर्ट किया. पुट का माइनस साइन है तो मतलब है मैंने पुट को राइट किया. I sold a put. If the stock has a minus sign like here, it means I sold the stock. If the C has a minus sign here, it means I have sold or I have written a call. Clear? तो माइनस का साइन है कि मैंने उसको शॉर्ट किया. And they may tell you in the exam, using this formula, they'll tell you what is the answer for PVX. You say fine, PVX. अच्छा लोग उधर लेके जाओ. PVX is P0 plus S0 minus C0, which is long put, long stop, short call. Understand? Long put, long short, long stop, and short call. So you should learn how to describe all the four options using the basic formula of covered call and protected put. Any questions?
No, sir.
Perfect. Very, very important. What I just explained to you. This comes in many options. Okay. Now you guys, now you find out. Now you see very easy. Okay. Do the sum and tell me what do you think should be the value of put option using the call put parity. Start. Stock price given to you. Exercise price is given to you. Call option is also given to you. What is the put option price? Very easy sum. What is the answer?
So 23.85.
20.
3.85.
Okay. So because the put option, call option is 59, right? Okay. So what do you know? It is C plus PVX equals to S plus P, right? You have C, you have PVX, you have S, correct? 59 plus, what is X? 265. 265 divided by 1.4%. What's the time period? 6 months. So raised to 0.5, right? P S को भी इधर आ रहा है. This is what? 295 minus 295 is equal to P. Did you get this much?
Yes, sir.
Very good. That means P is equal to how much? Good. That's it. So यार, now you'll wonder कि यार call 59 पे but तेरा आंसर 23 कैसे आ रहा है? Because you are all okay. Let me check the answer first. I think it's 23 is the answer, right? Yeah, very good. 23. Now, I want to ask you a question. Answer if you know this correctly. How come this is 23.8 but call is 59? How come there's such a wide gap? Bolo.
So the stock price is 295 and the exercise price is 265. So the exercise price is lower than the stock price. So the
Good.
value is
So the call already has an exercise value of $30. इसका मतलब ये जो 59 है उसमें 30 सो आज का प्रॉफिट है, आज का आज मिल जाएगा। बाकी टाइम वैल्यू इज $29, समझा? बट पुट में आज के आज कुछ नहीं मिलेगा तुझे, एंड टाइम वैल्यू इज एंटायरली 23.8 बिकॉज वो भी 20 से कम है, बिकॉज यहाँ पे टाइम value plus out of the money is a big deal. Understood? So don't always assume that they'll be close to each other. This is only because it already has an exercise value of $30 today itself. Here, very good answer. Very good. So upon this, I'm trying to understand why the disparity is there, and you got it right. Already there's a profit of $30 if I exercise the price today. Here, well done. Very good. And this is exactly how they'll test you on call put parity. Okay. Now I taught call put parity using options. You can also use put call parity using forwards, right? Forward में भी तो उसको replicate कर सकते हो. कैसे करोगे? Like this. You can replicate the asset by putting a forward contract and a risk-free bond. Remember, I want to pay. Let's say मेरे पास एक call है, तो मुझे वो कॉल को भरने के लिए I need to pay a certain amount of money after a period of time. So I want a risk-free bond which will pay me. I want a period money after that pays the forward price after a period of time. So that amount I can replicate through this cost put parity, right? Forward stock. Forward price is the stock price into 1 plus R, right? Future car. And therefore the stock price is the forward upon 1 plus R, right? We did this now. Stock into 1 plus R raised to n gives you forward, correct? Which also means stock is equal to forward discounted by 1 plus R. Right or wrong? Right? We learned this formula and therefore we learned this. So stock is multiplied to get forward, or stock is the discounted value of forward, correct? Same relationship you can replace in put call parity forward contract. What will you replace? Replace this burger S. S को अगर मैंने कर दिया है like this, I will get the same call to parity, but you need to replace S by this formula, which is forward, right, at time t upon 1 plus R raised to n, same, plus P, this is S plus P is equal to C plus, और X का भी same नाटक है, 1 plus R raised to n or T point. Clear? So this is the put call parity for forward, and that earlier slide is the put call parity for options. This one is the put call parity for options. Clear? Any questions?
No, sir.
Yeah. Again, don't learn something new. Try to remember what we are learning is an extension of the earlier learning, but in a different way. Right? The forward, the calls. Right? No questions? Yeah. Okay. Now, this is a very interesting one. You need to match for me. Wait, I'm seeing forward. Forward ka bhi aana chahiye. But this assume that now it's only for options. If I use it for forward also, you should get the similar responses. Okay. Forward options. Read this. Options. Find out. Now read the word. Be careful. Ye short hai. Short ka matlab hai minus sign. Short bola only. So this is minus sign. Okay. So rearrange your formula and find out what is on the other side. Okay. Start. Long pause. Try to clear the answer in your mind and then look for the option. Answer. Come on. What's the answer? It's easy, no? Long call. Formula क्या था? C plus PVX is equal to S plus P. तो इसको उधर लेके जाओ, right? Minus PVX. So कौन सा formula है? Long stock, long put and short PVI. Long stock, long put and short. So the answer is this. Right or wrong? Now short risk
Yes, sir.
मतलब PVX को short करना है तो इसको उधर लेके जाओ. So C इधर आएगा, S इधर आएगा, P भी इधर आएगा और उधर जाएगा minus PVX. PVX is risk free bond, उसको short किया, right? उधर चले जाओ. So क्या बचा है? Long call, short stop, short put. किधर है? Long call इधर है. Long call, short stop, short put. Answer आ गया. समझा? Short put means वापस P इधर था उसको इधर लेके जाओ. So minus P is equal to S तो already है, C को इधर लेके जाओ, PVX को भी इधर लेके जाओ. Right? What do you know of this? Long stop, short call, short PVX. Long stop, short call, short PVX. खत्म. That's how easy it is. Very, very important learning. तुझे फॉर्मूला को पता चल गया, बट फॉर्मूले के साथ खेल के अलग अलग वर्ड्स कैसे डालना है वो बहुत इंपॉर्टेंट है. You should know how to say long, short, and when they say short, remember you have to take P on one side and get the other on the side. So rearrange the formula every time. It's very important that you ace this. ठीक है? बहुत critical है. Any doubt?
No, sir.
Perfect. Sure. Very good. Okay. Now, potentially around the last few slides here. Call option. So this is obviously from a firm value point of view, right? Now you know that an enterprise value, right, is nothing but the value of the enterprise plus the earnings plus the dividend, right? The firm is earning dividend. So what the dividend of the present value है, that will be adding to the firm's value, correct? Now obviously I say firm value is earnings plus dividend. I'm assuming that firm's debt finances is SC, there's no debt. Okay. Now solvency, value of the firm potentially will be greater than debt. Okay. If there is a debt, value of the firm is equal to equity plus debt, right? Which means equity value will be equal to value of the firm minus debt. Correct? Okay. Now if the solvent, that means the firm will have sufficient money to pay debt and equity, at least the debt. So value should be more than debt. If the firm is solvent. If the firm is insolvent, that means it is not able to pay debt also. You got the logic? So solvency is more than debt, insolvency is less than debt, right? Now this, if you can apply to options, right? Call option. You know what the value of call option? It is the amount that you're going to get from the share price minus X, right? Call option matlab S minus X tha. S minus X is 0. So same way, what is the value of the firm? Shareholders. तुझे कितना पैसा मिलेगा? You will get the value from the company minus pay the debt. So you will get the amount from paying the selling assets and the debt. But even though you don't get enough money, you will not be asked to pay money. So it will be 0. Right or wrong? Same logic है. If you're a shareholder, you will get either the residual or nothing. Same in call. You will get residual or nothing. So can I conclude that owning equity is same as having a call option on the asset? Long call. You have the right to sell and get your money or go home, get nothing. You don't have to pay. That's the good news. Right or wrong? Same way for put option. तुमने ऑप्शन लिया सेल करने का तो यू गेट इधर एक्स माइनस एस और 0. डेट का भी तो सेम फंडा है. डेट को या तो उसको he get the value which the firm has remaining value or he get the full value. He get either his entire D or he get the residual and he will suffer a loss. So debt is also as good as having a long bond plus a short put. Matlab, he owns the bonds, but he's also sold a put option on those shares, right? Because if you see, यहाँ पे VT or debt, so VT minus S and plus S निकल गया. So he has gone for short put. Okay? So learn these two carefully. Owning equity is like a call option, and owning debt is like a bond plus short put. Now you know a bond is PVX. correct? And short put is what? Minus P, correct? So this is as good as saying, so if you remember C plus PVX equal to S plus P, right? C is removed and S is on this side, right? And C goes here, right? C goes here, C goes here. So a stock minus the short call is equal to the long bond and the short put. Okay, this will give you the debt of the company. So learn these two equations from a firm valuation point of view, okay, which helps you to conclude that equity is like a long call and debt is like a long bond, PVX plus a short put. Okay, and that's how we connect the dots. Okay, sure. Take care. Thanks. Bye. Take care.